Mr. NA Ansari. He's the CEO of Steel Business for Jindal Steel. Mr. Ansari, good morning and thanks so much for joining us on ET Now. In the June quarter, like I was just flagging off, India became a net steel importer for the first time in 2 years. However, there's been significant depreciation in the rupee since June. In the last 2-3 months, the rupee has fallen significantly. So has this worked towards making imported steel a little less competitive than domestic steel?
So, I think we need to look at it in totality. So what is also happening is that because a lot of raw material is still being imported in India, the entire coking coal comes up from outside. And today, in fact, it is also true that substantial quantity of iron ore has also started coming within India. So therefore, the people who are making steel and those who are importing these raw materials, they are also very adversely affected because of that. So that is one point which is there. At the same time, for any imports to come from outside, the steel coming from outside, obviously it will also be more difficult for them to compete because their currency is higher. But on the other hand, if you look at global scenario, if you look at Turkey, for example, their lira has really gone down very, very substantially. So for countries like Turkey to start exporting, it becomes a very lucrative business to do that. So the net point which I'm really trying to communicate to you is that this exchange rate, for us being adversely affecting is not only for the imported material but also for the imported raw material, and therefore our cost is also going up very significantly because of that. So it's not really a situation where we can say that okay, the Indian steel industry is winning because...
No, Mr. Ansari, actually you just answered my next question as well, that given India's dependence on imported coking coal, even iron ore now, you mentioned that it is a bit of a worry for costs. Your costs have gone up, but has it gone up to such an extent that it has negated the benefits of being more competitive than imports given the fall in the rupee?
So, let me first talk about what's happening on the cost front in Indian steel. So, if you, let's say, compare between June this year vis-a-vis now, if merely because of the exchange rate increase as well as because of the iron ore prices have gone up very, very significantly. I think in the last 3-4 months from June, I think it has already gone up by about 1,250-1,300 rupees or so, which is a very significant percent. So therefore, overall the cost impact on Indian steel industry is somewhere about 3,500, depending on where one is located, maybe somewhere between 3,000 to 4,000 rupees. So that is one aspect which is there. Now obviously, if you compare the prices between June and September prices have not moved so significantly compared to June. So there would be certainly a push on the prices because of this cost push which is really happening. I'm absolutely sure that in the coming weeks or months the prices would rise significantly. Now once the prices rise, in the same way the people who are importing or from outside countries, they would also get an opportunity to try and enter that. So we need to be extremely wary about that, and that's the point which we have been talking about. We have some FTAs with some of the countries, and that is something which we must really have a relook at, because if we do not do anything at all, then those imports will start becoming much more compared to what it is, and that will very adversely affect the steel industry. You remember, because of those FTAs, these materials come within the country at zero import duty, and that is something which nowhere else in the world today is really happening. So we will become the dumping yard for those people who have got the FTAs with us.
Okay, now there have been lots of talks about the government once again planning to introduce import duty on steel to essentially curb those imports. They're terming it as a non-necessary imports. And again, there's been a lot of to and fro from the government with respect to that. But do you believe that would be effective towards reducing imports?
Yes, certainly. I mean, anything, because if you look at what's happening throughout the world, everywhere people are creating those walls which are there, and if we don't do that as a country, I think we will become the net losers, especially for the domestic producers. And that's something I'm sure government doesn't really want it to happen. So therefore, they're all looking at the possibility, and that certainly would be a very welcome step.
Yes, absolutely. But for now, of course, we have to wait for any firm government announcement with respect to the same. I have to ask you about the debt management plans as well. We know that you are looking to cut debt by 2,500 crore rupees by the end of this fiscal. Now, what I want to know is to what extent is asset monetization going to play a role in reducing your debt?
So, as you're aware, our debt level is somewhere close to about 42,500, around that number. I don't know the exact, don't remember the exact number, but it is somewhere in that region. And that number, simply based on the repayment and some additional payment which we are making, it is already coming down. So the target which we said that it will come down by 2,500, we really expect that it will come down by even more than that. So, we are on very much on the target as, based on what we had stated earlier, we are moving as per that.
Okay, is the listing of the Oman business on the cards? I mean, what are you looking at divesting? Any rough valuation that you may have figured out for the Oman business?
So you see this, you have already seen the statement made by Mr. Naveen Jindal. Certainly we are looking at part divestment of Oman facilities. That has been a point which has already been discussed earlier with all our lenders and so on, and certainly we are moving in that direction. The work is on. We have people are working on it, and by this financial year end, you should be hearing something about it. We should be very close to moving in that direction. As regards the valuation, I think we really don't want to start talking about valuation just like that. But let me tell you that we have spent a very substantial amount in our plant, and with the kind of EBITDA which we have, roughly close to about $300 million for the year, we should have a substantial multiplying factor, and based on the current debt which is there, we certainly expect very good numbers. But I'm really not going to talk about what numbers we are really expecting to come out of that.
Okay, so we'll catch you then at the end of FY19 when the business does get listed as well. But I must also talk to you about something else that Mr. Jindal had alluded to, and that's splitting up of your businesses, Steel, Power and International, into 3 individual entities. So if you could just talk a bit about that to our viewers as well, because the stock has rallied significantly on the back of that news, this value unlocking process that Jindal Steel seems to be in the midst of. What discussions have been there? By when are you looking at this? Some details on this account?
So this is a matter which has again been talked earlier. We are all as a management group, we are all very intensively discussing this. We also need to discuss this with our board, our lenders, and all the shareholders. So we need to do all that, and that's the process which is on. We certainly are working towards both unlocking the value for our shareholders as well as having the maximum focus on each of these businesses. The 3 businesses has already been talked about, our chairman, but right now all I can tell you, these are all under discussion and work in progress. Beyond that, I'm not really in a position to tell you anything more.
Okay, fair enough. Mr. Ansari, thanks so much for joining in on ET Now, very candidly answering all of our questions and queries. It's provided a lot of clarity to our viewers. We wish you all the very best for your debt management plans.